Today, a Sunday chart fest. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and property news with a distinctively Australian flavour. Well, each month the Reserve Bank releases their chart pack. And the chart pack contains a whole bunch of interesting information relating to our economy locally, international statistics, and a bunch of other things too. So I thought it would be interesting just to walk through this pack and explore some of the key trends that we can see. And as I go through, I'm just going to tell you a little bit about my perspective on the data and also perhaps highlight some of the questions that I have relating to the data itself. So let's get started. And you can see from the table of contents that there is a lot of information to cover. 30 pages times about 4 charts a page. So this may take some time, but nevertheless, it does tell a very interesting story. We're going to start with the world economy and GDP growth. And of course, there's been a considerable shift in GDP growth. If you look at it on a world basis, you can see there was a deep dip thanks to COVID, and then it's recovered. That's partly, of course, the base effect. And things changed a little bit if you look at China and India compared with East Asia, or indeed the advanced economies, the US, the Eurozone, and Japan. And it's interesting to note that in the advanced economies, growth has actually spiked up and then spiked back. Now a lot of that, of course, is the base effect. And to be clear, the base effect is simply that if you start from a big number and then move to a small number and then a big number again, the percentage change is a lot bigger. But there is also something else to talk about here in terms of the question as to whether, in fact, growth is going to be as strong as it was initially forecast. Now, if you look at inflation, again, you can see that the advanced economy inflation rate has considerably moved up, particularly in the Eurozone and in the US, less so in Japan. But if you look at inflation in China and India, for example, then it's a completely different story. Indeed, in East Asia. And what this tells you is that, to an extent, the story of inflation in the US and in the Eurozone is a bit different from many other parts of the world. That begs the question, of course, if the Fed starts to react, lifting interest rates because of inflationary fears there, what's that going to do to the rest of economies around the world where inflation may be less of an issue? Now, if you then look at the labour markets, you can see that there was a considerable spike in unemployment, which is coming back a little, and that wages growth does vary quite considerably comparing the US, the Eurozone, and Japan. And interestingly, the US has seen a considerable spike and return, less so in the Eurozone, and even less so in Japan. Now let's look at China activity indicators. And here you can see that whether you look at PMI or industrial production or retail sales or fixed asset investments, they are all going considerably south from where they were. There was obviously a spike post-COVID, but now things are weakening. And if you look at the residential property indicators, investment growth, new property price growth, even floor space sold or floor space started, they're all declining. If you then look at the financing growth, well, housing loans are down a little bit, business financing is a little sideways, government bonds is down. And if you look at output across the various sectors, you can see that there's a considerable fall in steel production, crude steel, although you can see that some other factors, like for example electricity generation, is stronger, but even things like plate glass and cement are somewhat down. So the indicators from China suggests slower economic growth ahead. Now let's look at GDP growth in Australia, and there was of course a big fall followed by a big spike, and it's come back more recently. If you look at the contributions of GDP growth, you can see that the government actually contributed the largest component in the September quarter, followed by non-mining investment and consumption of households and dwelling investments and exports. Mining investment hardly made a difference. If you then look at the mining and non-mining activity, you can see that there has been a tail back in non-mining activity, and mining activity itself is also a little down from where it was. And if you look across the states, there are considerable differences. So, for example, comparing New South Wales and Victoria with Western Australia or the rest of Australia. Those states that have been most severely hit by COVID are having the most issues at the moment. So if we look at the Australian inflation, well, the consumer price inflation, of course, is a lot stronger than it was, dropped considerably. Again, that is partly the base effect, but the measure of underlying inflation also is ticking up now. And as I've discussed before, one of the questions, of course, is how we measure inflation and whether all the information is appropriate and accurate. I have a view that inflation is understated, of course. It's also worth just highlighting the difference between tradable and non-tradable inflation. Tradable, excluding volatiles, is somewhat lower, whereas non-tradables is somewhat higher. Now, if you look at the household sector, you can see there that disposable income has come back a little. Consumption was up, then down. The savings ratio was up, down, and is back up again. Now, these numbers, I think, are somewhat all over the place, so I'm not sure how accurate they really are at the moment. Consumer sentiment is somewhat down, and it's probably going to continue lower given the current COVID cycle. Private dwelling investment is pretty strong, and private residential building approvals has dropped through the floor. That's true for higher density housing as well as detached housing. The detached housing story, of course, was inflated by the government stimulus over the home builder program, and that pulled forward a lot of residential development. Trouble is, of course, much of that development won't get completed for a year or two or more. Now, if we look at house prices and housing debt, well, housing prices have rocketed higher. That's using data from CoreLogic, of course. And the household debt ratio is ticking up again. It's still very high, but of course this doesn't tell the full story because this is the total position of household debt. Not all households have debt. 1/3 of households actually have mortgages. And so you need to multiply that by 3 to get closer to the real household debt ratio relating to housing. In terms of household wealth and liabilities, net wealth has increased thanks to the value of property rising, and also financial assets, which have also done quite well over the last 12 months thanks to all the government stimulus. Liabilities, in other words loans, are rising. And once again, I'll highlight the fact that the liabilities is not equally spread across all households. Looking at the house price movements, all of the main indices, whether it's the APM, CoreLogic, or ABS that derives it from CoreLogic, very strongly up. And of course, we know the reasons for that, not least the very free lending and the very cheap debt. And the housing loan commitments, excluding refinance, ran very much up over the last little while, but is sliding back now. Now, turning to the business sector, the share of nominal GDP in terms of business investment is way down from where it was, and that's one of the biggest issues we have. Business investment is very weak. In terms of capital expenditure, mining expenditure has come off significantly compared with a decade ago, and non-mining investment is a little lower than where it was, but isn't looking too bad. Now, if we look at the business investment by component, we can see that the machinery and equipment investment has slid back. Buildings was very strong and has come way back now, and engineering has continued. And if I look at by industry segment, the mining boom, of course, is registering there very strongly, then the construction boom, but quite a few other segments really have hardly improved over the decade. Now, if we look at non-financial corporate profits, you can see that the mining sector has been very profitable relative to non-mining, that lending to business has come back, particularly for the large business sector. I'd also highlight the fact that small business lending has gone nowhere for a decade plus. That's a real concern. I think small businesses are under the gun. And if you look at the latest NAB business survey, business conditions, well, that's come back. Business confidence was up and down. It's risen a little. I think it may come back now, given where we are with COVID. And capacity utilization is just above average, but again, moves quite a lot. Now, in terms of business lending rates, you can see there that lending rates for all sectors of the economy, small business, medium business, and large businesses are lower. That, of course, is reflecting the lower cost of capital and the lower RBA rates. But also highlight the fact that lending to business for the small business sector has hardly grown at all. In fact, it's lower now than it was in 2019. Lending for big business has risen slightly, especially unsecured lending, and medium businesses are borrowing slightly more, but there's very little real growth over the last couple of years. And business loan commitments reflects that as well. It's also worth highlighting the construction sector has been up and down. A lot of the purchase of property is there too, and I'd highlight also working capital, which is a very important element. Many businesses are struggling with working capital, according to my surveys. And by industry, you can see there that some sectors highly affected by COVID, for example, accommodation and food and administration, are significantly down, whereas rental, agriculture, and other services and construction, less impacted by COVID, just continue to borrow. Then if we look at the broad money, we can see there that credit growth has finally accelerated. It took a long time. Broad money is quite a lot stronger, not as high as it was at one stage, and that's because the government support has been removed. Housing credit has been growing more recently, particularly owner-occupied housing credit. Investor credit was in negative territory. It's now come slightly positive, but nevertheless, the story is still one of owner-occupied credit growth. In terms of money aggregates, the M3 and currency have moved around quite a lot, obviously under the influence of government policy. And looking at credit growth by sector, housing growth is quite strong. Lending for business is a bit all over the place, and personal lending is still significantly lower in terms of growth than where it was in 2009-10. Let's now look at factors of production. So net capital stock is down, the working age population is down, the wage price index was significantly down, is moving up, but is still very weak. That's going to be an ongoing issue for us, I think. In terms of the capital ratios, the labour ratio is higher, the output ratio is up a bit as well. That's a question of productivity. Productivity is still not going in the right direction. And if you look at the unit labour cost growth in the non-farm sector, there's been a considerable rise. The average earnings per hour, though, have not followed that, and labour productivity per hour is also weak. So we have an economy where essentially productivity continues to languish. Now let's look at employment and participation. The participation rate moved around quite a lot through COVID. It's somewhat down from where it was. Some of that is explained by people choosing to leave the workforce. We may see more of that ahead, I think. In terms of employment and hours worked, the hours worked are down. In fact, there was a considerable drop through COVID phase 1, and we're seeing now another drop as the lockdowns continue to rattle through. Underutilisation is also quite strong even now. The underemployment rate is above 9%. It did hit a higher rate at the worst of the first phase of COVID. And in terms of job vacancies and advertisements, they have gone up, but they've slid back more recently. If I look at the industries and regions, you can see there that New South Wales has been struggling and Victoria has been struggling, Queensland to an extent as well, whereas WA has been moving in a completely different direction. South Australia and Tasmania have been somewhat weaker as well. The employment ratios do vary quite considerably across the states, with Western Australia and Tasmania and South Australia in one phase, whereas Queensland, Victoria, and New South Wales in a different phase, again, I think because of COVID. If I look at the industry share of output, other business services, including, of course, the real estate sector, has been very strong, whereas retail and wholesale trade and manufacturing have been less strong. Mining, pretty strong still, and agriculture bumping along the bottom. And translating that into employment growth by industry, you can see that household services was growing very strongly. It's come back a little bit now. Business services, somewhat. And some of the other sectors has been pretty much unchanged. Construction was higher. It's come back a bit now. If we look at the government sector, the Australian government budget balance is still in negative territory. The state budgets are considerably in negative territory. And a lot of the momentum from public construction hit a peak in 2009 and is, to an extent, still quite strong, but not as strong as previously. And in terms of revenue growth from taxation, there is a bit of a spike now as corporate income tax improves. There was clearly a slide at the beginning of COVID. Now, in terms of the index of commodity prices, still quite high. And you can see there that the Japanese and Korean LNG spot price is extremely high. So costs of oil, costs of LNG up. The bulk commodity prices moving in quite different directions. Thermal coal and coking coal very strong. Iron ore prices considerably weaker than previously, although they've come up against since. But overall, the terms of trade don't look too bad. Very reliant, of course, on the commodity sector. And in terms of the balance of payment and external position, the resources sector pretty strong, services significantly weaker, rural somewhat weaker as well, and manufacturing, well, bumping along but slid back more recently. And if we look at the resource exports, you can see there that iron ore and LNG have really been very strong, coal less so. In terms of input volumes, they are somewhat down, particularly for those relating to services. And in terms of exports by destination, China is still by far the largest destination. Japanese exports are down as a proportion, and indeed most other areas are. So despite all of the noise around China, the fact is we are very reliant on exports to China. So whatever happens to China, will definitely impact us here. In terms of the current account balance, the trade balances did improve. The capital inflow and outflow is actually negative at the moment. The net foreign liabilities show that long-term debt is still quite high, short-term debt less so, and equity is lower than it was. And in terms of the external position, you can see that our foreign liabilities are higher than ever. So we are somewhat exposed to what happens on the international scene at the capital market level and also at the political level. In terms of the central bank balance sheet, you can see there that the RBA's assets have accelerated considerably and continues to accelerate thanks to their quantitative easing programs, and that is reflected also in the liabilities. So we have a bigger reserve balance sheet than previously. And if you compare the central bank assets as a percentage of GDP, the growth in Australia is more aggressive than pretty much all other Western economies. It's also worth noting that in terms of holdings, the Australian share of government bonds has accelerated considerably. In terms of interest rates, the Australian cash rate, of course, has fallen through the floor. There is an expectation that at some point rates might move higher, but I think the Reserve Bank's call is still farther out than many other central banks. Policy rates are also pretty low as well, and you can see there that pretty much whether you're looking at the US, the Eurozone or Japan, rates are extremely low or indeed negative in the case of Japan. The question is, will they move up? Well, the Federal Reserve has signalled they probably will lift rates. And that could have a significant impact on the cash rate here and the 90-day bill rate, which of course is sitting very low. And in terms of real returns, the cash rate is negative at the moment. So we are living in a real negative rate environment. And ahead, you would have to say that policy rates are likely to rise, although in Australia, perhaps slower rather than other countries. Now, looking at the monetary policy in China, you can see there that the reserve requirement ratios have been ratcheted down, that the interest rates have been considerably lowered. In the emerging markets, you can see the same with policy rates dropping, although in some places now they are beginning to move up. The bond yield for the 10-year in Australia is already moving up, and the chances are we will see that move higher. And 10-year government bonds around the world are beginning now to uptick. We'll see more of that ahead, I think, as some rates, particularly bond markets, are expecting higher rates ahead. Now, it's quite interesting to look at the spread between the 10-year bond yield and the cash rate target. That has actually moved up a little, but it's still close to where it's been over the last couple of decades. The bond yields for non-financial corporates have moved up a little, but is still significantly cheaper than previously. And the differential between Australian and US 10-year government bonds has started to move up. We may well see a more considerable shift if the US does lift rates. And the Australian non-financial corporate bond spreads are very, very low at the moment. Now, the US corporate bond yields are rising, and that will continue. The Chinese corporate bond yields probably will continue to slide sideways or even go down. The US corporate bond spreads are coming a little higher, but are still considerably lower compared with where they were in, say, 2009 or even in 2014 and 15. And the emerging bond markets, bond yields are also lower, considerably lower, but rising slightly. So we're in a weird position where bond yields are still very low. Now, looking at variable housing interest rates, the major bank reference rate is sitting below 5%. New loans are being written at considerably below that, although there now are some signs of fixed rates starting to move higher. And Interestingly, both the swap rate and the advertised rates of fixed year loans is up. Housing interest rates is somewhat down, and business lending rates are also lower than where they were, but there are some signs, particularly amongst small businesses, of them not being able to access finance, and when they do access finance, they have to pay higher rates. If we look at the share price, you can see that the markets have done extremely well, although the ASX 200 performed less well than the S&P 500. In the advanced economies, they have done better, with the US leading the way, Japan not so much. And in the emerging markets, again, you can see that there has been some movement up, although it's been more constrained. Talking about bonds on issue in Australia, non-government bonds have been rising, but Australian government bond issuance has been the most significant, then with state governments also issuing. So this is very much part of the quantitative easing program. In fact, the total non-government bonds on issue across all currency denominations have fallen, particularly in the financial sector, as financial companies are relying more on deposits. You can see there that the non-government bond issuance is predominantly issued in the domestic situation. And non-government bonds on issue in Australia are still quite high. Financials are still quite high. Asset-backed securitization has moved up again. Non-financial corporations have issued some, but the non-residential is definitely weaker. And if we look at the US and Euro corporate bond issuance, you can see there that, again, non-financials and financials were strong, a little less so now. And in the Euro area, issuance is considerably down from where it was back in 2009 or before. And in terms of emerging corporate bond issuance, local currency denominated bonds in China are strong. In other places, foreign currency denominated bonds are also quite active. Then if we turn to the Australian dollar trade weighted index, you can see there that the real rate and nominal rate moved up and has come back slightly. The official reserve assets have risen. The Australian dollar has tended to slide and probably will continue to slide compared with the US. And the US dollar has been somewhat stronger because of the economic recovery that is reported in the US. Comparing selected Asian currencies against the US dollar, you can see there that most have become a little weaker. The G3 nominal trade-weighted indices have been frankly all over the place, with significant volatility in the yen and the US dollar. And in terms of the Chinese renminbi, the nominal effective exchange rates are a little up compared with previously. Now let's look at the banking indicators. The banking profitability is somewhat lower. That's true of both the majors and other Australian-owned banks. That's because of margin compression and competition in the mortgage sector. If you look at the Australian bank profits by the majors, you can see that they have been able to return significantly stronger profit results the last time around, thanks to significant reductions in the bad and doubtful debt charges. It's been a bit of an accounting fest in terms of being able to try to support the banking profitability, but the margins are actually under pressure, and that's shown by the net interest margin, which is just above 2%. By the way, that's still quite a good number relative to other banks in other parts of the world. In terms of non-performing assets, the issues relating to the business sector are somewhat under control. Housing delinquencies are moving up very slightly. Personal delinquencies are somewhat higher. And the impaired assets are considerably lower than where they were back in 2011. In terms of funding composition of the banks in Australia, the domestic Deposits are up to about 60%. Short-term debt is down and longer-term debt is down. And of course, the banks also had benefit of the term funding facility, the very cheap money from the RBA. As a result of all that, the capital ratios are pretty strong, with Tier 1 and also CET1 ratios, as well as total somewhat higher. And interestingly, the credit unions now are not quite so strong as some of the banks. So if you stand back and think about all of that, what do we see? Well, I think there are three things. Firstly, you can see how strongly the economy has been supported by government investment. Secondly, you can see that the momentum around manufacturing and growth for the future is very weak. And thirdly, how reliant we still are on China and on those commodity exports. We have a very narrowly based economy. And of course, the question is what happens ahead. And the final point I'd make is that we're still very reliant on housing, housing wealth, housing debt. And of course, if the housing sector starts to turn negative, which it's possible it could ahead, that could be a very significant downdraft. But the bottom line for me is that the story in these charts is an economy that is not well balanced. It's an economy that's highly exposed to externalities from China, from the US, from interest rates, and of course COVID as well. And the lack of clarity in terms of policy and long-term development in Australia, frankly, is coming home to roost. So to my mind, we need a very different way of thinking about the economy and where we invest and how we invest. And just pursuing the housing and holes as strategy really is not going to do us well into the medium and long term. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.